And this one will really surprise some of you who are retirees. When you start looking at your top 3 expenses, you might discover that your top expenses, very commonly, is going to be your income taxes. And it's not going to be something you're aware of because often you have amounts that are being withheld from your Social Security or your pension if you're taking IRA withdrawals. But when you pull your tax return and you look at what your total amount of taxes are, and then compare that to what some of your other expenses are, yours might be income taxes in retirement, which is really not always a real pleasant surprise for many of you. In that case, you have some opportunity to work with your tax person, work with a financial advisor to determine, is there any way that you could restructure some of your income to see if you could drop that expense down just a little bit. Now, one of the other things that I generally have available is an irregular expense account. Now, this is something that I do to try to levelize a budget expense for my clients. So we're going to put down those things that only occur once a quarter, once a year. How about Christmas? What about birth dates? What do you do for recreation? How about vacations, auto repairs, your out-of-pocket expenses that you have for your medical? Do you only pay your life insurance annually because it saves you 3 to 8% to do that versus on a monthly basis? How often do you pay car insurance? Again, the lower the frequency that you pay your insurances, usually will cut the price by 3 to 8% when you compare it to monthly. Do you have periodic house cleaning or carpet cleaning? What about tree trimming every year? All of those things that can go into the expenses that aren't necessarily something that happen every month. And if we can take those expenses and let's pretend that I look at them and I come up with a number. And then with my number, I think I'm spending about $10,000 a year on all of these expenses because I spent a few minutes looking at it. And then I'm going to increase that by another 20% for the things I've forgotten. Or I'm looking at some things are going to cost me a little more going forward. So I'm now at $12,000 a year. I'm going to have a completely separate account that is for my irregular expenses, clothing, everything that's going to be in there. I'm going to deposit $1,000 a month into that account. So $1,000 a month equals $12,000 a year. Now, whenever I have those expenses, I'm going to take it out of that account. So I've made it a level budget expense. And I always have money to pay for these things instead of falling back on credit cards. And in my perfect world, I'd like you to jumpstart it with 3 to 4 months if you can, in case you just get it started. And then maybe you've got a large medical expense and you have to pay $2,000 out of pocket and you'll feel defeated before you even began. But the irregular expense accounts work very, very well. Throughout the year, you can watch that account balance. And if it is never enough, you might have underestimated your expenses and you can look back and see where you erred. If the money continues to grow, it may be that there's a bigger expense you have not paid for yet because it hasn't occurred, like a significant car repair. Maybe you haven't taken that vacation that you had allocated the funds for. So an irregular expense account can be very helpful when we're looking at managing our cash flow. We need to talk a little bit about what I call the deep, dark debt hole. I don't care what happened. Something happened. Many of you are in debt and you're really discouraged because it doesn't seem to matter how much money you throw into that deep, dark debt hole. You cannot ever fill it up. You can get to where you can see daylight and something happens. Your only option is to grab the credit card and to go ahead and pay it, and you start over because now you're back in debt in that deep, dark debt hole. For many of you, let's stop. Get with a financial person who can help you, and let's make a plan to get you out of that deep, dark debt hole within 3 to 7 years. And for many of you, 3 to 7 years is what it's going to take to get you to the point that you're out of the credit cards and you're out of that debt hole. It can be done. One of the things that we're going to do, in addition to coming up with a plan to pay these debts off, is you remember that irregular expense account? We're going to be working on funding things so that when you have an issue come up, instead of having to grab the credit card and pay the outrageous interest some of them want, which is 20% plus that many of you have, we're going to take $1 out of savings to pay for $1 of goods. Period. Those of you who keep putting things on credit cards, thinking that you're going to pay it off someday, it's not happening. When you bought that item, the first year you paid $1 plus the interest on that dollar because it's still sitting out there. You never paid the balance off. It could be 15 to 30 cents. So that's $1 plus 15 to 30 cents in year one. You know what? You never paid it off in year two either. So let's add another 15 to 30 cents. And year three, and year four, and year five. And you simply cannot sustain paying $1.60 or $2 or more for every dollar because of all of that accumulated interest that just doesn't stop. The other thing that would be helpful, you want to seek out and secure lower interest rate credit cards. Look at some of your credit cards and what you're paying, and then look at your payments each month that you're making, how much goes to interest, how much goes to principal. And if you're not paying it off and you're struggling, those balances may actually be creeping up just a little bit. And so let's look at that. Sometimes we can do balance transfers. There's things we can do, but often you need to talk to a financial professional to help you get out of that deep, dark debt hole, but then also put you in a much better position going forward. And now we're going to do just a little bit of math. And when I say let's do a little bit of math, a lot of you have got your cell phones handy. So let's grab a cell phone and let's look at that. I'm going to give you an example. This was an individual that I had worked with. And on this individual, they drank a lot of soft drinks. What we were discovering is that when they are drinking these soft drinks, and let's grab your little calculator, I'm going to grab mine so that we can do this little example together. This particular person, we'll call it during the work week, drank at least 5 cans a day. So we're going to go 5 times 5 times, and they were spending $1.25 for it, and it's gone up now, but let's say it's $1.25 at the vending machine that they have. Well, that is $31.25 during the week that we're spending just on cans of Coke. Now, do you really think that they're not going to drink Coke throughout the weekend if they're buying it during the week? And of course, they're going to stop by and they're going to get it in a can, run through the drive-up window, whatever. So we're looking at this. So let's say that they spend even maybe another, we'll be really conservative here, $10. So now we're up to $41.25 a week. Okay. Times 52 weeks in a year. So we're spending $2,145 on a soft drink. Now, if this person, hypothetically, is earning $25 an hour. And of course, we haven't taken into account taxes and things, have we? So let's knock that down and say they're really only earning $15 an hour. Take that 2,145 you've got on your calculator, and I'm going to divide it by $15 an hour, which is 143 hours divided by 40 hours in a week. So they are working approximately 3.5 weeks of every year in order to pay for soft drinks in the method that they're using now. It is not sustainable. In 10 years, how much is that? We're talking thousands of dollars. That's why they love us when we have a habit. One of the things that we came up with, I said, it's okay. You want to drink, a soft drink? I have no problem with that. I have a problem with the way you're paying for it. Let's do something different so we can create the money to do something else. So let's get it. When it's $6.99 for a 24-can case, and you're going to put this away, we know that throughout the year, you need about 76 cases a year in order to do your habit. And that will knock the price down to $531 a year. Wow. Did it change the behavior? The answer is slightly yes. Instead of getting it out of a vending machine, he had a little cooler. You maybe have a fridge at work or whatever, and took it and drank it and dropped the cost of it dramatically. Instead of pulling in and getting one from a drive up where you're going to spend a couple of bucks on it, no, get you a little cooler, invest in that, and go forward. So there's sometimes little things that we can do with our cash flow that can have a huge difference in what we do and what we do with what's left over. Let me give you another one. This is a rule in my family. If you were ever with, me and our kids, this is what we did. And we had 6 children. So it's one of those things. I say, water, please. We're all trained. So if you were a family of 4 and you go out to a restaurant of any kind, and they serve tap water. Yes, you can drink tap water with ice. I'm a family of 4 and I'm ordering free water, or I bring my own, not bottled, depends on what your scenario is. I can save at least $12 a meal per person with a generous 20% tip. And I'm assuming that we're only paying $2.50 for that drink and you are not getting a refill. We all know that when you get your drinks before the meal and you're drinking them, and then during your meal, you're going to want another one. So if you are in the refill mode, you probably could save closer to $24 per meal. If you did this only once a week, what's $12 a week times 52 weeks? Well, it's $624 that you could divert somewhere else if you wanted to. Again, if you are someone who would do the refills, you're over $1,200 a year that you could divert in another place. Now, let me tell you about the $5 cash game and that change jar you have. There was a young lady that I worked with, and she had this little game that she came up with because she paid cash for different things so that she would really be able to control her spending. Whenever she received a $5 bill, she put it in a different place in her purse. And at the end of the month, she took that amount and she put it in savings for all the $5 bills. What she learned in this experiment is if you take out a $20 bill and you're going to pay for something nominal, like a small pack of gum or something else, and they hand you back 3 $5 bills, there doesn't give you a whole lot of money to spend on anything else. She said it made her think about even some of the smaller purchases she made with the thought of, well, if they give me back a $5 bill, I'm not going to have much to work with. So that was the $5 game that she had invented. I thought it was very clever, really. She accumulated much more than she anticipated by having that, because every month she took all those accumulated $5 bills and she put them into the bank, and it didn't affect her lifestyle a tremendous amount. It was a game, but she felt she was winning the game too. Some of you have change jars. You can't. Why are you keeping those change jars? Take the change jars, have it, roll them, do whatever's necessary, take it in, get it into a savings account, use it to fund your Roth IRA. Do something with it that is of value rather than just accumulating it, because what do you think is going to happen to it? That money is never going to get to be a bigger number just sitting in the jar. There's another little one that I can share with you. Had a lot of success with this. It's called the soup debt diet. It's something that I came up with quite some time ago to work with some individuals who were struggling in a group setting type of a thing. What I want you to do is one week a month, just 1 week a month, 2 meals a day are going to be soup. I don't even care what type of soup it is. So for your lunch and your dinner, you're going to have soup. Now with that, we are going to take the money that we are saving in our grocery bill by having soup, two meals a day for just 1 week. And we're going to set a budget on what we're going to spend. Maybe it's on a bag of apples or bananas or some other fruit. And we're going to limit what our amount is we're going to spend on that. Maybe you'll get a specialty bread. Whatever it is that is the extra to kind of round that meal out for you. But the amount of money that you save because your grocery bill drops so much during that week, we're going to take 50% of that money and we're going to pay down that high interest debt. We're going to take the other 50% of the money and we're going to put it into savings. Now, some of you are going to be able to save little dibs and dabs and put them in the freezer. So making your soup is really relatively free or inexpensive because we're not throwing food away. But I think you'll find if you use the soup debt diet, it's really not hard to do. It doesn't change your lifestyle a tremendous amount, but it can help get you out of debt. It can help build the savings in a very easy way. You're not a cook. Maybe you're going to pick up the cans of soup and you're going to do it that way. I have a booklet that I put together some time ago that has some of my favorite soup recipes that are easy. So reach out, send us a note. We'll need an email address and we'll send that out to you if you'd like. But it's the Soup Debt Diet book. Now let's talk a little bit about, can you make some minor changes and what could it do for your future? Now I'm going to have my staff go ahead and put up a slide for us that minor changes. You're going to see a chart here and it has an appreciation rate. I've taken a nominal 5%, not trying to do anything crazy here. If you look at the top line, if we start with nothing and we add $25 a month and 5% probably is going to be in a mutual fund, something like that. This is an example. And in 5 years, I would have about $1,695. In 10 years, $3,859. And in 40 years, over $37,000 is what I'd have. And then I want you to look down at the bottom example. Now, at the bottom example, we've increased it to $250 a month. And you'll see that the growth is exponential. But I want you to understand how much did it cost you. If we took $250 a month and we put that away for 40 years, it only cost you $120,000. The value of that compounding and the value of the growth is what grew the account to over $370,000. Something to think about. So I've told people before, how much does $1 million cost? Well, depends on when you start. If you start in your 20s, it's going to cost you a lot less than in your 30s. It's going to cost you less than when you're in your 40s. It's probably going to be unobtainable in your 50s. And if you wait until your 60s to try to accumulate $1 million, you're not going to have anything left to live on in most cases. One thing that we should touch on a little bit is your FICO score, because that FICO score is going to be a real determining factor on what you're going to qualify for when it comes to credit cards and what some of those interest rates are going to be. That also is going to affect the interest rate potentially on a home loan or for an auto loan. Now, if we look back, and I call this a secret squirrel society. Now, in the secret squirrel society, they don't tell us exactly how you calculate the credit score because they don't really want you to know, so you can't manipulate it. But if you look over on the left-hand side, we have kind of an idea of what the weight is on the different categories. So we're told that it's about 35% is your payment history, and about 30% is based on the amount you owe. About 15% is the length of your credit history. About 10% is how recently have you had any new credit lines opened up. And about 10% is the types of credit that you have. If you look on the right side, you're going to see that a score of 800 or higher is exceptional credit. You are managing your resources very, very wisely. You are not overextended. And then the rates go down to where 740 to 799 is very dependable. The next category is good. And then we've got some will be approved. Notice that could also say most will be denied. And then at 579 and below, very, very risky. And I would not expect to see very many things that were approved at that point. Now, for many of you, you have got credit cards, or banks will offer this usually as a part of your online experience, where you can go in and check and see what your credit score is. Now, in looking to see what your credit score is, you have an idea, and it will also show you what your 6-month history is. This is free. It's usually included in a benefit. Again, this is with your credit cards, often with your bank. It's very important for you to know what your credit scores are, and then to also watch those periodically on what you'd like to be. Again, because your lender is looking at it, if you were a lender and you were looking at applications on your desk that potentially wanted a car loan, and you had a choice between approving one at 515, which is a very risky score. We have one at 753, which is very dependable. And we have a score at 621, which, yeah, I'm not sure if I'm going to approve it or not. My guess is that this 515 is not going to be approved for the loan. Probably would have to have a cosigner, and they'd probably have to have very good to exceptional credit. The 621 might approve it. Remember those debt to income ratios? It's going to depend. And why did this happen? Did somebody come out of a divorce, a medical issue? Why is the score so low? Might have a little leniency, may not. The 753, as long as a few other things are in line, really should not have a problem getting a car loan. So all of these things come into play. And would any of you like to guess at what some of the historical amounts are for credit scores? Well, really, they've hovered around about 700. They've gone up a few points here and there. They've stayed in the good score category, even into 22, 23. We haven't reached anything on very dependable. You know, the average, it's just kind of good. We've got young people. And when young people are starting out, they're going to have those 500 and below scores because they don't have a credit history. One of the things that I am encouraging parents to do, or a grandparent, depends on the situation, if you have good credit, I'm going to ask you to consider setting up a credit card and have it be the co-signed for that individual so that they can start building a credit history. And it might be only $500 or $1,000 on their credit line. And what we're going to train this young person to do is, I want you once or twice a month to put on a tank of gas. I want you to buy a few things at the grocery store that you normally would buy anyway. The day the credit card comes in, I want you to schedule the payment and make sure it's paid before the due date. If you will do this, in the majority of the cases, if they're responsible, within 12 to 18 months, they're going to have a credit score, and you probably can get your name taken off the account, or they can open a new account under their own name with a credit rating that has been established. That is the perfect scenario. Let me tell you when it's not perfect. Let's pretend that I gave my child a $500 credit card that we are both on so they could even have it. And they're charging up a bunch of stuff. They're not paying it off. The first month goes by and we have a late fee, or they just, well, I can't afford to do that. I haven't got the money this month. I'll pay it next time. No, 1 or 2 dings, you close the credit card, because it's going to affect your credit. And if you end up having to pay this off, experiment is over. We do not want to give that child too much rope to hang themselves. And usually 500 to 1,000, depending upon what the dynamics are, is more than enough. Now, another thing could happen if someone does not have a credit score, or they've got a very poor credit score. It could be called a secured credit card. Now, a secured credit card could be issued by a bank, or it could be issued by a credit union. And with those, you would have to put on deposit. For a $500 credit card limit, you'd have to put $500 on deposit that you cannot touch. And then after a period of time, if you use this credit card and you pay it off on a regular basis and you build your credit back up, there will be a point in time Well, they will release that deposit and it no longer has to be held in case you don't pay the credit card bill. So if we need to build credit, sometimes a secured credit card may be your answer. Now, it is essential on any of these scenarios that you want to pay the accounts on time so we can eliminate the late fees because they can be expensive. A late fee could be $25 to $40 for each time. Many credit cards, they have language that is default language that says that if your payment is late once or twice in a cycle, that we can raise your interest rate to a maximum of 29.99%. You don't want that to happen because you'll pay more forever on that for years. And if you are bumping up against the limit on your credit lines, you can have over limit fees. So in the same month, you could be hit with an over limit fee, which might be another $25, $35, $40 on top of a late payment fee. And that over limit fee will continue until you get that balance down below whatever your credit line was. So these can add up very, very quickly. If you have overdraft protection on your checking account and you keep using it all of the time, that's another scenario that, number one, it's a bad habit. And there are fees that are associated with that. And we've got to work on the cash flow so that overdrafts on the checking account are not a normal event for you. This is going to have repercussions later. And if there are any bounce check fees because you don't have overdraft protection, then you're going to have very expensive per check fees. You're going to get charged at the merchant. You're going to get charged at the bank. Your reputation could be an issue going forward. So there are a lot of reasons that we do not want to tap into credit lines or have any overdrafts on a checking account. Now, some of you are thinking, well, I know I'll just pay with cash. But let me tell you, paying with cash, that can hurt you too, because you will have no credit history when you do need something. You will have low or no credit score. It's very hard to track your expenses, and you also don't get the perks that come along with some of the credit cards. One of the other things is you got to watch your fees. I dealt with a senior couple some time back that didn't realize. I said, let's see your bank statements as we were looking at all of the pieces. Why are you paying almost $20 a month in service fees? And they go, oh, we never balance our checkbook. I don't know. We surely not. And I said, well, yes, you are. And in looking, they still had a very old account version. That old account version was charging them 50 cents per debit card transaction for more than 10 a month. Well, they thought they were being prudent and using their debit card for everything that they bought. So even if they only bought a $5 purchase or a $2 purchase, they were paying that 50-cent debit fee. We changed accounts, made some things different, but it can be substantial. Now, for some of you that do not have Air Miles cards, you could be missing out on free airlines tickets. I enjoy those and I appreciate it. And there is also a card that I have with an airline that I frequent, that all I have to do is pay for my ticket with that card. And I also get my first checked bag free. And that's good for up to 4 people in my party if they are on the same reservation number. Do the math. That's worth at least $200 one way to me if there's 4 of us, and another $200 going back. I don't get those kind of perks when I pay cash, but you have to pay on time to make any of these type of programs work, or they're just not going to work for you. So does it really matter? Well, there's a lot of cards out there that you can get 1% cash back. You can get 2% cash back. Some of them have categories for 3% cash back or 5% cash back. I already mentioned to you, what about free checked bags? What about multiplier programs? Do you have free rental car damage coverage? We rented a car not too long ago. It was really nice to not have to pay that amount, because before I ever was at the rental car counter, I had already verified that my credit card included that damage coverage on a rental car. The fine print said that it would pay for the repairs or the value of the car, whichever was a lesser amount. But the All I had to do was trigger that coverage, was use that card to pay for the rental. So that was worth a substantial amount. Again, paying cash, you're not going to get some of those things. Now let's put that a little bit more into context. If I was paying that 50-cent debit charge 10 times a week, 52 weeks a year, that's $260. If I had $2,000 a month in spending that I could put on a 2% cashback credit card, that's another $480 I could have. So that is $740 that I would have left behind if I don't take a little effort to tweak things and make it a little better. Now, if that's $740 in 1 year, and you say, yeah, no, that's not that much. In 10 years, that's $7,400. Do you have anything different that you could do with $7,400? I think you probably do. So sometimes making these little things, types of changes will make a big difference. But at the same time, you've got to pay on time to make them work. And you do a little bit of research to pick up those programs that are really going to help you the most. The other thing that I mentioned is air miles. So let me give you a couple of ideas on the air miles. When I'm looking at my air miles, I have a credit card that I can pay for the flight and I will get 2% cash back. So that's an option. If I know I'm going to be checking baggage, I have a credit card that I can use that gives me miles and allows me to have a free bag. That's in the equation. Let's pretend that I can buy a one-way ticket worth $543 and 12,500 miles are required. Well, that is very easy for me to figure out. I take $543 divided by 12,500 and I come up with 4.344 cents is what each mile is worth if I use miles to pay for this flight. Compared to if I bought, a one-way ticket, I'm only going to get 2%. So depending upon what the circumstances are and how much each mile is worth to you or cash back, it can have a difference, and all of these little changes can add up substantially. Anything you can put on the credit card, I generally do. And some of you are going to go, oh my God, Amy, there is no way that I could afford this really big fat credit card bill that you're talking about. And I'm going to say, yes, you can if you manage your cash flow wisely. Let's take an example. Let's say that you have money in your checkbook that you would normally be paying for these items with. So if you're not spending it in the checkbook and you're putting it on the credit card, that money should be in your checkbook. If I bought the item on January 1st and then my statement closed on January 25th, I probably have a due date that is maybe February 23rd. I want to make sure I pay it before the due date, but that money has been in my account from January 1st to when the bill was due on February 23rd. And if you don't spend the money in the checking account on things that you do not need and you wouldn't be spending on anyway, the money is always going to be there. And there can be some advantages to building that up too. This question always comes up whenever there is a lot of credit card and other debts out there is, well, why don't I just file bankruptcy? I don't have to pay it out over 3 to 7 years and, it'll just be easier. I'm going to tell you it's not. When you look at filing bankruptcy, there are situations where it truly is the answer. Filing bankruptcy for a few $1,000s that you could work off over a couple of years by picking up a part-time job or selling something, no, that's not a wise use of bankruptcy. It will follow you on your reputation for years, not just on your credit report. There are many jobs, there are licensing, there are credentialing, there are other things that will ask, have you filed bankruptcy? And it could be the factor that keeps you from renewing a license, obtaining a credential, qualifying for something. So there's a long-term effect. The attorney's expenses are not free. The attorney's expenses are paid before the bankruptcy is filed to make sure. Now, you could also think incorrectly that you're going to be able to eliminate all of your debt because you file bankruptcy. That is not true. Not all of your debts will go to zero. Some of it will depend on where the debt is from, such as if you owe IRS taxes, do you have student loans? When did you put all of the charges on the credit cards? Because if you ran out and did a spending spree and you spent, I don't know, $5,000 on your credit cards to use the last little bit that was available and got a bunch of things, and then you file bankruptcy 3 days later, that is not going to fly. Any judge or credit card company can see that. So bankruptcy, not always a free pass. So the other option can be debt consolidation. Well, if you're looking at debt consolidation, I will tell you debt consolidation will not solve your cash flow problems. If we don't get to the root of why we can't eliminate the debt, you're only going to stay in that deep, dark debt hole. Debt consolidation may be a Band-Aid for a very short period of time, but it doesn't solve the underlying problem on your cash flow. We've got to address it and fix that, because consolidation, that's really not going to take care of it. Now, for some of you that have balances outstanding, you're going to be looking at, well, can I refinance something because I'm paying these outrageous, 20% plus rates? The answer is maybe. With some of the clients that I've worked with, they had vehicles that were paid for or mostly paid off, and it made sense to refinance an auto loan because it was a single-digit interest rate. And we had a set term, could be 2 or 3 years where that was going to be paid off. We were going to keep the car during that time frame. Now, that's an option. Some of you will consider refinancing on a home loan. Is it a lower rate? Do you really want to pay interest on some of your credit cards for the next 15 to 30 years? Because if you roll it into refinancing a house, that's exactly what you're doing. And it goes back to, if we do not fix some of those underlying problems that we have in cash flow, refinancing your home, that's probably not going to fix the problem either. We can do balance transfers between credit cards. Many cases, it can be 0% for, 12 to 18 months. Get some help when you're putting these in place to make sure it's in your best interest. But again, we've got to deal with some of the underlying cash flow issues. Doing balance transfers can work at the 0% to more rapidly decrease the payoff balances, but you may need to be systematic about it. If I did a 12-month 0% balance transfer offer, then in about 10 or 11 months, I'm going to be looking for another offer to transfer that money again at the lowest interest rate. Because if I leave it on the card where I've done the 0% balance transfer, what's that going to rate be when that special expires? Yeah. And if you put something on a card that is got one of the 0% balance transfers, don't put any other charges on that card. If you read the fine print, in most cases, they'll want to apply your payment to the lowest interest balance, which means your 0% could get a payment, and this amount that you put on is accruing at 24 or 25, whatever that percentage is, and the interest is racking up and adding every month. So you got a 0% balance transfer or a very low rate, you do not add anything to that card. If you have got credit card offers or you're talking about debt consolidation, reach out to me if you need help evaluating the offers. Reach out to a credit counselor. Reach out to somebody who can help you sift through them to see what's in your best interest. But again, you got to deal with those underlying spending issue. There are some other borrowing options. I'm not going to spend a lot of time on them. You could do a reverse mortgage if you are a retiree and you're over the age of 65. You've got to have equity in your home, but you got to have an exit plan. It's a different class, but on that exit plan, the reasons that someone might do a reverse mortgage at retirement is they want to pull the equity out of the home and use that in order to subsidize or support and keep their standard of living up. It may also allow them to eliminate a mortgage payment. So there can be some very good reasons for doing a reverse mortgage. I can have just as many that are not good reasons, which goes back to, Are we only delaying the inevitable that the house is going to need to be sold because we cannot afford the taxes, the insurance, and the maintenance and the repairs? I'm getting older too. Some repairs we can't do anymore. We may have been able to do them 10, 15, 20, 25 years ago, but we can't do them now. And the cost of hiring it out, that's one of those costs of home ownership that you've got to take into account. If the intent was to pass the home to the children and now we've encumbered it with a mortgage, that may not suit the purposes that you had in mind. Or we may need to take part of the proceeds and purchase life insurance to pay off the mortgage so the kids get the house free and clear, which was what your intention was originally. What's the right answer? I don't know, because all of you are so very different. But if you reach out for help, we can figure out what the right answer is. Some of you have cash value life insurance. You may look at cash value life insurance and say, oh, this is perfect. I'll take it out of here and that will solve my problem. It probably won't solve your problem. Once you borrow from a life insurance policy, it reduces the death benefit for the amount of the loan. In addition to that, depending on the policy, the interest rate will vary. Every year that money is not paid back, it accrues interest, and that payback balance gets higher, that ends up getting deducted out of the death proceeds. There are situations where you have taken out so much or dividend scales aren't what they anticipated they would be. And if you don't pump extra money into the policy, it will implode and it could potentially cause a taxable event. So before you think about taking cash value out of your life insurance policies, once again, you need to talk to a professional. You need to deal with the underlying problem and figure out what's going to be the best scenario here. That may be a resource that you need later. Now, if I'm reaching, and I mean really reaching far, to think for any other options, maybe you pawn something at a pawn shop. That's not going to be cheap either, because you're going to have to pay it or you're going to lose the item. You could sell something. No, I think that's better than the pawn shop in a lot of cases if you're going to have difficulty redeeming it. Never, ever, never, never, ever payday loans. Oh my gosh. Look, you call me. You want to pay somewhere around 800 or 1,000% interest because you can't get it paid back in the way some of these work, or 200 or 300. You just reach out to some of the rest of us, because we would be more than happy to earn ridiculous amounts of interest. Don't do the payday loans. You can't. That is a whole different kind of a deep, dark hole I've seen people get in. Maybe you get a part-time job. I think as we're going through this, we need to touch base on borrowing and lending to family members and friends. This is a business transaction. Anytime you have a loan between two parties, you want to have a formal document that's signed off. That is your proof that the debt exists. If you have to go to court to get it, or if you have to present that in a estate because the person has passed away. And we want to be clear that everybody understands what the terms are. If it is a loan, it will include the word loans along with the repayment schedule, the interest rate, and we're going to sign off on this agreement. If it is a gift, then we are going to write a check, and in the memo, we're going to put gift, or we're going to have some other document that says the word gift. So there is no question that this is a gift. Now, for some of you that are doing substantial loans, maybe I loaned a nephew $200,000 to start his chartering business. We're going to have a formal loan agreement. We may end up putting life insurance on my nephew as a part of the agreement in the event that he passes away before he has paid me back my $200,000, that I would receive the life insurance proceeds. So my debt has been settled and I am no part of his estate and whatever else they decide to do with it. In some cases, I have switched this up in the event that the lender, we put insurance on the lender. So if the lender passes away, then the Borrower receives the life insurance proceeds. Think about mom loaning money to son to buy a house, mom and dad. Then if mom passed away, the son receives the life insurance proceeds and uses that to pay off the debt. So that debt isn't a part of his mother's estate, and he doesn't have to pay back, his brothers and sisters. And it's just a mess. You don't want it. And they end up with a property that is free and clear. So there are ways that when we're working with borrowing and lending and family members, that we can set this up so that it works for everybody. There's another little thing that's called the AFR. Whether you do a short-term, a medium-term, or a long-term loan, there are minimum amounts of interest that you need to pay. That you need to charge in order for it to be, let's call it a very comfortable above board transaction. And those rates are generally lower than what you're going to see at banks and credit unions. Don't know much about this, but you're thinking about it, reach out. I'll be more than happy to work with some of the families and things to do what you'd like to do, but let's do it the smart way. There's other things that we can do with gifting, where you gift and you give them like 15%, $15,000. Remember, I'm not perfect. You could potentially give an individual $15,000 as a gift each year, and maybe instead of giving it to them in cash, you reduce the amount of the loan by that amount as part of your estate planning. So we've got lots of different options. But again, we need to take care of the underlying spending issues and look at it to make sure that these type of arrangements are really the best for everybody. Well, my gosh, we have covered a tremendous amount of things when it comes to managing your resources, and I've touched on a lot of topics. Thank you for being here. And if there are some questions or comments, please put those down. I would appreciate it if you would click the like button if you found this to be very helpful. Always love it when you subscribe to the channel. And if you will share this on social media on other individuals that you know that this would be helpful, please do that. Well, I'm Amy Rose Herrick. I am a profit building specialist, and I'm here to help. Thank you so much for being with me.